Hello, welcome to our first ever on-demand quarterly economic update. Here we are in the summer of 2023. One of the things I've learned from all of you about the summer is many of you are out having fun on vacation, and making it to an economic update, either in person or online, just isn't convenient. So we are trying this out here this year to see if you prefer this method for the summer. Our intent is to stay with our in-person version during the other parts of the year, but I'd like to offer a more convenient way for you to get our quarterly economic update that works on your schedule. So let's dive right in. Our agenda is going to look very familiar. We're going to begin our discussion with a talk about the economy. I'm going to address this concern some of you have shared with me about the economy slowing, and are we going to run into a recession at some point, and what would that mean for us? Then we'll talk about equities or stocks. We will discuss bonds. Then we'll wrap up our discussion talking about asset allocation strategies based on where we see the economy headed in the future. So how is the economy doing? Well, we just got the GDP print for the second quarter, and it was better than expected. So this slide here we can see shows that we are at the 2% trend line growth that we've been seeing since the mid-2000s. The second quarter GDP came in at 2.4%. The expectation was for it to be closer to where we were in the first quarter of around 2%. So that's encouraging. For sure, that indicates, hey, we're doing better than maybe you would expect at this point of an interest rate hiking cycle. The other part of the economy we've had our eye on some time regards inflation. And so inflation is starting to trend down convincingly. And without going through all of the individual data, just look at the trend that we've seen over the last few months. So we peaked late last year, and now we're seeing a definite trend downwards, and that's great. In fact, the one number that the Fed likes to look at is this core PCE deflator. And you can see it dropped to 4.1 from 4.6% just over the last month. The expectation was it would drop to about 4.4. So it's nice to see inflation surprising to the good side versus the bad side, which is the experience that we had in most of 2022. And that will affect what the Federal Reserve is going to do with interest rates, which we'll talk about in a little bit. The other thing I look at, inflation's driven a lot by wages and wage growth acceleration. And so wage growth is represented on this slide by this light blue line. And when wage growth spiked and was continuing to go up last year, that was a concern because wage growth creates sticky inflation. But now we're seeing wage growth taper off. And so that's another positive in the fight against inflation. So even with the Federal Reserve trying to slow the economy by raising interest rates in their fight against inflation, we see that unemployment is still at historic lows. And the expectation is, you can see this on the Fed slide here, that it's really not going to get above 5%. And that's encouraging because 2/3 of economic growth is driven by consumer spending. And if consumers have jobs, they have money to spend. And so it's hard to imagine a scenario where you have a deep recession when there are plenty of jobs available. You can see in prior recessions here during the pandemic and again during the financial crisis of 08-09, unemployment got north of 10%. We're not expected to go anywhere near that. And that's very encouraging for the economy as well. Let's tackle this question of, are we in a recession head on? Recently, I heard an analyst on Bloomberg Radio suggest this idea that we are in a rolling recession. And I thought that really nailed it with the experience that we're seeing. Because what happened during the pandemic is we were all locked at home. We had money. In fact, we were given money by the government, and we spent that on goods. And that spending has now shifted to the services that we couldn't enjoy while we were locked in at home. So more spending at restaurants, definitely more spending on travel. And here's a great slide LPL put together that I think does a good job of showing this. So the blue line here is services, the orange line is goods. And so when you look at goods, right in 2020, the beginning, you can see exactly when the pandemic started because we started buying a lot of goods and we stopped spending money on services. And we really had that level spending throughout over the last year and a half or two that after we've started to get out. But the expectation is that these are going to revert back to the norm. And I think we're already seeing that. We are seeing slowdowns in manufacturing, but we're seeing very robust demand for services and travel and leisure. So that's really where I think we are with the recession question is we may be seeing it in certain parts of the economy, but not the overall economy, at least not at the moment. And you know that I like to share what I call the Purchasing Managers Index. Well, I don't call it that. That's what it's called. I like to share it because it's a leading indicator of where certain parts of the economy are headed. And it's a survey of purchasing managers that asks them to forecast where their industry's headed, whether it's expansion or contraction in the near future. And so when they calculate this number, and here we're looking at manufacturing PMI, if the number is above 50, that indicates that industry is expanding, or that part of the economy, manufacturing, is expanding. And so you can see we're below 50, and that indicates contraction. We're not dramatically below 50 like we were in the pandemic or in the great financial crisis of 08-09, but we are slightly negative there. And that goes with the discussion I just had of we're spending less on goods and services, and we're spending more on services. So let's take a look at the services PMI, and you can see services dipped below 50, then it climbed back up, then it dipped a little bit, but now again over 50. So this supports that idea of rolling recession. We're seeing it in manufacturing. We're not necessarily seeing it in the service side of the economy. The good news is services is 4/5 of the economy. So the largest part of the economy is looking at expansion as we move forward from here. That said, I've heard a number of you share concerns about where you think the economy's headed and what it might mean for our investments. I'm encouraged that I hear those things from you because when consumer confidence is low, the market tends to do very well over the next 12 months after it sets in a bottom. And if you look up here in this tiny little graph on the upper left, you'll see that the 9 troughs, so the 9 bottom levels of consumer confidence going back to the 70s, the average return for stocks over the next 12 months, 24%. The reverse is also true. When everybody feels great, the average return over the next 12 months is 3.5. So I like when you are all sharing with me that you have concerns about where the economy's headed. You're not as confident. That to me is a bullish signal. I've always felt that way. And you can see the low in consumer confidence happened in June of 2022. And since then, the market's been up 17%. So hopefully history is repeating itself. The nice thing here is we're still not back to the average consumer confidence, so maybe there's room to grow. You know I don't make forecasts on markets, but I'm encouraged that the market is acting as it has in the past with regard to this statistic. All right, let's move on now to discuss equities. So equities have actually had a pretty good year so far. In fact, technically, we've already started another bull market defined as a 20% increase off the bottom of the prior low. And so you see this happen in October. We hit the low of the markets and we're up more than 20% since that low. And what's encouraging about that is that doesn't mean the party's over. In fact, here's another slide LPL put together I really like. And it shows the average return after the markets had this first 20% move at the beginning of a bull market. So you see 3 months out, there's an average 5.1% return after that first 20%. 6 months out, it's another 12%. 12 months out, it looks like you almost have a repeat. So another 18.9% return on average after that first market move. Now, this doesn't mean this is going to be exactly what happens to us, but you can see the percentage of time that you have positive moves after that first 20% increase at the beginning of a new bull market. 83% of the time, the market is positive 3 months after that first move. 6 months after, 75% of the time it's positive. The year after, more than 90% of the time, the market's had a positive movement after that first move in the bull market. So history hopefully will repeat itself for us and we'll have that kind of experience. One thing I always like to look at with you, though, is valuations. And so if we look at this chart here, it's showing the average forward PE over the last 25 years. And that 25-year average is 16.78. Sorry, I needed to peek at it. My eyes aren't so great with this small print. And I apologize if you're watching on an iPad or an iPhone. I know you can't see a thing here either. But you can see that since the bottom of the bear market, we've seen valuations climbing higher and higher. So we're reaching that top line, which I said anytime you get to the top line of this particular chart, you're starting to reach somewhat overvalued area in the market. If you hit the bottom line, things are undervalued. So we are definitely approaching that top line. Things that could pull it back from the top line are if we have a really good earnings season with companies. And so we'll look over the next quarter and really see how earnings are going. It looks pretty good so far. So we'll see how that goes. So there's one part of this number that I think is a little bit distorted. And let me move forward a slide and show you what I mean. And it's over here in the upper right. The weight of the top 10 stocks in the S&P is 31.4%. So almost a third of that S&P data, that number, is made up by 10 stocks. These tend to be the tech-heavy stocks. These are the stocks that have had a significant rally based on expectations around AI, artificial intelligence. And so I think what we're seeing in the valuation number that we just looked at on the prior slide is driven by these 10 stocks, not as much by the broad market. So this table here shows a little bit more detail. So the top 10 stocks, the average valuation over the last 25 years is 20.2. The current valuation is 28.8. So quite a bit difference from the average. The remaining stocks, the average valuation is 15.7. The current valuation is 18.3. So the broader market seems to be closer to fair value than these top 10 companies. One of the things we've done in your portfolios made sure that you're broadly diversified, so you're not so reliant on those top 10 companies in the S&P index. All right, time for an AI cartoon. Oh no, my robo-dog ate my AI written essay. Oh, if that isn't the sign of the times, I don't know what is. Okay, two last slides before we move on to bonds. The first one is something I've talked about in prior discussions, which is how are value stocks doing relative to growth? We overweighted value back in 2021, which has served us well. And we did it because of this chart you see on the left here. When you look at this chart, if this gray line is below the center line, it means that value stocks are cheap relative to growth stocks. And there was a point where earlier this year, I thought, okay, we're going to remove that tilt towards value stocks, that overweight we put on value stocks, probably sometime in the near future. And then because of that AI rally that really pushed growth stock valuations higher, you can see that value stocks started getting cheaper again. So I'm not as quick right now to remove that tilt towards value because they're looking like a better bargain versus growth stocks. You're still going to own both value and growth stocks. We're just going to keep that overweight on the value stocks right now in the portfolios, given what we're seeing in the markets. Okay, so this slide's going to look at international stocks for us. And it's similar data to the one that we looked at for the US stocks and just the PE discount to US stocks. So once you get below the center line, which international stocks are clearly below that center line, it means those valuations are becoming more attractive. Those stock prices are down from their historical averages. And you can see that once you've reached not one, but two standard deviations, that really doesn't happen often. And so what I take away from this particular graph is still a lot of upside potential on the international side of our portfolio, just because things are so cheap. Yes, Europe is having a bigger challenge getting out of their inflation problem than we are, and they are having recessions. But the best time to like something is when everybody else hates it. And clearly, the markets are saying, hey, we hate international right now. And that's why these valuations are so cheap. So I'm encouraged by that and what it can do for us in our portfolios. Let's move on now to discuss what's happening in the bond market. it has been an interesting year and a half for bonds. And when we look at what's happened over the last 16 months, the Federal Reserve has raised rates 11 times. And so, at the beginning of 2022, the Fed funds rate was somewhere between 0 and 0.25%. And now we're 5.25 to 5.5%. And that sent quite a shock into the economy as far as interest rates go. We saw bond prices drop last year, double digits. We've not seen that before. You're seeing mortgage rates north of 7%. And so that's created some issues about slowing the economy, which is what the Federal Reserve is trying to do. In fact, there was some current concern back in March and April about some of the smaller community banks and how their bond portfolios reserves were holding up during this period of distress. And so there's a lot of focus on what does the Federal Reserve do from here. And in their meeting in this last week of July, they indicated that they're going to be very data dependent. The Federal Reserve is going to make sure that they don't drop interest rates before they absolutely have to. Because frankly, they were behind the curve, realizing that inflation was going to be a problem. They don't want to make the same mistake with inflation on the way down by letting off the brakes too early. And so I think that what they said at their meeting this week is, we're going to be data driven and we're open to further interest rate increases. My takeaway is that whether they raise it again or not, I don't think they're going to be quick to drop rates unless we really see inflation falling quickly. And so here is an interesting chart of what the bond market is actually saying that the Federal Reserve might do and what the Federal Reserve is saying they might do. So when we look at where we are now, it looks like through 2023, rates are going to hold steady. And then through 2024, you're going to see, and this is the blue is the Federal Reserve estimates. They may drop rates a little bit, assuming that the economy slows more than they want it to, or slows enough where they feel like inflation is going to be okay. But they're not going to drop rates to where they were. And the market doesn't think that either. The market's represented by this green line here. And even over the long run, as you look out where we're going 2025 and beyond, you see these rates in the 3% range, nowhere near the zero that we saw since the Great Recession. And I think that's true. And one of the things that's good about that is it means that the bonds in our portfolio are actually generating more return than they have in some time. And so I'm encouraged by that. And especially the short-term bonds are generating a nice income for us. So one of the things I did a YouTube video on a couple months ago was just about this relationship between interest rates and bond prices. And you've heard me say before, it's kind of like this teeter-totter, where interest rates are on one side, bond prices are on the other. And when interest rates go up, like they have over the last 16 months, you see bond prices fall. And I've added a little data here in that the longer term bonds tend to fall more than the shorter term bonds. So one thing we did in 2021 is we knew that we were likely going to head into a rising interest rate environment. We moved much of your bond holdings towards these shorter maturities. So we're not impacted as much by these rising interest rates with regard to our bond prices falling. And at some point when rates do start to go down, we're going to look at the reverse. So we may move some of the short-term bonds out to slightly longer maturities. There's a bit more complexity here because there's an inverted yield curve, and so maybe these maturities in the middle aren't going to move as much. Frankly, the discussion I've had with bond managers over the last couple of weeks is that prices might move more in the 2 to 3 year range just because of this inverted yield curve. More than I want to get into in this economic discussion. But if you have questions around that, feel free to give me a call or shoot me an email. I'm happy to talk in more detail about, this deep in the weeds bond stuff. But, JP Morgan put together a slide that I thought was kind of cool. And I want to look at this, let me get the pointer here. So I want to look at this data over here on the right, and it shows the impact of a 1% rise or fall in interest rates. And so the blue is if there's a fall in interest rates, and it's different maturities. So just let's look at the top 2, 5, 10, 30-year maturities. And you can see that the shorter maturities go up, but not as much as the long maturities do. And the same is true on the downside, is that the longer maturities go up. The long maturities go down more than the short maturities go down. And so that's that teeter-totter effect. But because of this distortion in the yield curve, it's expected that maybe this 2 to 5 year range might be a sweet spot. So if that appears to be the case, and we start to see the Fed is getting closer to a decrease in interest rates, or they're going to drop rates, we'll probably adjust the portfolio of bonds, maybe a little bit longer maturities than we are right now. But right now, no action really is required. All right, so let's move on to the last item on our agenda, which is discussing asset allocation. One of the more interesting things that's happening in the market right now is, frankly, the CD rates that we're seeing, right? And this next chart shows short-term treasuries, but I'm seeing CD rates follow these same trajectories. So whether you're looking for 1 month out to 1 year CDs, the rates are right around 5%, if slightly above 5%. That's something we haven't seen in more than a decade. So it becomes tempting to say, well, why don't I just move to these low risk CDs and capture this 5% rate of return, and not worry about fluctuating financial markets? And the reason I'm bringing this up specifically is there's two. Let me show you the first one. So when we look at the 12-month returns of different asset classes after a rate hike cycle, and you've seen CD rates peak, that's what we're seeing here. So I'm not saying that we're at the peak of the interest rate hike cycle at this point. We're a lot closer to it than we have been, and we won't know until we're past it that that's what's happened. But let's take a look at history where we've seen different interest rate hiking cycles, what CDs have done, and then what the other asset classes have done over the next 12 months after that peak. So if you look back in the 80s, you saw CD rates peaked at 10. Man, we should have loaded up, right? Well, inflation was much higher than 10 at that point. But if you look at US high yield bonds over the next 12 months, return 27%. Let's just look at stocks. The green bar here, up 24%. If you look at the late 80s, 89, CDs also at 10% over the next 12 months. You saw stocks have another good year. Mid 90s, CDs around 7. The next 12 months, stocks did really well. 2000s, same thing, although stocks did not do very well in this scenario. That was the dot-com bust, if you remember. Here's a scenario closer to where we are now. 06, you saw CD rates peak around 5 or 6%. Stocks did really well right after that. And then in 2019, you can see CD rates. We did have a rate hike cycle. It sure doesn't look like it, but stocks did pretty well there. The point is, we don't know what the next set of bar charts was going to look like. But to exclude other asset classes, I think, is just a mistake. To overweight in short-term fixed income is a mistake. And it's for one particular reason. For all of you that are retired, I'm going to give you a slide that out of my book where I talk about this living off the interest strategy. Why don't we put all the money in the 5% CDs and not worry about market fluctuation? So I give that example. I said, if somebody's got a $500,000 IRA, they earn 5% on that, they're going to get $25,000 in interest. And what if they just use that for their living expenses, so that, at the end of that year, they still have $500,000 in their IRA? It's a beautiful scenario, right? So same thing happens in year 2. You earn $25,000, you take $25,000 out, you still have your $500,000. And that happens the 3rd year, the 4th year, so on and so on and so on. Why this is a terrible idea is it does not keep up with rising living costs. So in the book, I talk about, hey, when you retire using 3.5% inflation, slightly below where we are right now, the first decade cost about what you expect, but the second decade costs 1.5 times as much as the first decade. The third decade of retirement costs 2 times what the first decade costs. And as our cow said, that's a lot of moolah. Now, this is graphically what the living off the interest strategy looks like. You're getting this $25,000 per year income in a world where living costs continue to rise. And at some point, you're not able to keep up. So as tempting as these short-term rates are right now, it's important for us to always consider our long-term asset allocation and not get seduced by these rates that we haven't seen sometime, because the biggest threat for all retirees is not market fluctuation, it's inflation. And that's why we're doing these growth and income portfolios, so we have a chance to stay ahead of these rising living costs. I'll wrap up with this last slide, which shows annual returns on a 60-40 portfolio, 60% stocks, 40% bonds. We're going back here to 1950, so just after World War II. And, each bar kind of shows how that portfolio did. But if I just showed you this chart, take all the numbers off this chart and just showed you this chart, and I said, here's an investment and here's its historical performance. And if the bar is above the line, it had a good year. If it's below the line, it had a bad year. If all you could see was this chart with no numbers, would that be an interesting investment? I can tell you personally, I would be interested, because when I'm looking at the percentage between up years and down years, it's pretty compelling. And so short-term market fluctuation is going to happen, but the idea here is we have to keep our eye on the ball. The biggest challenge for all of us, especially right now, is inflation and rising living costs continuing to increase at a rapid pace. We need to have growth opportunities in the portfolio to have a chance to keep up with that challenge. So that is our economic update for the third quarter of 2023. One thing I'd like to ask is, if you like this video, you can click a thumbs up so I know that. One of the things that compliance requires is that I turn off the comment section on YouTube. So if you have comments, questions, give me a call, shoot me an email. I'd love to hear your feedback on if you like this format for our summer economic update. Also, if you click on this channel, you'll find other YouTube videos that I'm creating. As time goes by, I'll do shorter economic updates, some educational updates. And finally, I'm putting my book, Holy Cow, You're Retiring, online. So all of that content will be available. If there's somebody that you know that you think could benefit from that information or this economic update, please feel free to share that with them. And finally, if you know somebody that's retiring or already retired that needs a fantastic financial advisor, please feel free to share our information. Shameless plug. There you go. Again, thanks for your time. Stay tuned for the disclosures.